All right, Abhishek, thanks a lot for taking us through the highlights of that report. So perhaps 2023 would be another good year for the banking space. That is the word coming in from CLSA. But from banks, let's move on and talk about tech. JP Morgan has written an interesting note on what they expect for the IT sector going forward. Rima, tell us more about this.
Well, they've titled the 2023 Outlook report on IT as the Great Reset. So for starters, they're saying that growth rates for the Indian IT companies will come down from mid-teens to 6 to 8% for calendar year 2023 and 2024. This reduction in growth will be on the back of higher furloughs, as we are seeing, flat technology budgets in the current year, inflation, large deals are not coming. Without large deals, it's hard for large companies to see a double-digit growth and pricing pressure as inflation continues to eat them. Secondly, JP Morgan has also heard, in their conversations with various industry experts and companies, there is a possibility that the furloughs that we saw in Q3 will extend into Q4 as well. That's another point. Thirdly, so while growth will slide in calendar year 23 and 24, what they're saying is that it's not that after that, 25 onwards, things are going to pick up because there are a lack of any new disruptive tech drivers beyond digital cloud adoption cycles. So according to them, growth rate from here on is going to remain very moderate. And also, if you do not have a top line growth, it's hard to grow your margins because companies lack operating leverage. So it's going to be hard for companies to recover the margins that they've lost in the year gone by. Also, they're saying that in the current quarter, Q3, FY23, if companies report weak numbers, you're going to say, well, it's on the back of furloughs and things will recover Q4 onwards. But they're saying that Q4 is also likely to be weak, and then come April, May, June, when you will get the guidance from the companies for the next year. They expect that is also going to remain fairly muted, and that is going to drive a PE correction. So Q3 you could discount, saying that it's the furloughs, but if you get weak numbers, which they are anticipating in Q4, and they're saying that in April as well, when the guidance from the next company for the next year comes out, it's going to remain weak. It's going to drive a PE reset downward, PE downgrade. And look at where the valuations are versus the pre-COVID average valuations. Valuations are still about 20-30% higher than what they were, and according to them, that is going to come down. The PED rating is likely to pick up in the next 6 months. They're underweight largely on the entire sector. They've got a neutral call only on Infosys and Tech Mahindra, and in all the other places, you would see that the target price set by JP Morgan is lower than where the stocks are currently are. So for TCS, the target price is 3,000. For HCL Tech, the target price is about 880. So that's the outlook coming in from JP Morgan, the Great Reset.
Okay, let's see how that shapes up. Meanwhile, Jefferies expects the operating leverage to continue to surprise for industrials in the year ahead. Vivek is here to give us all the details. Vivek, this seems to be the common narrative, right? That industrials, manufacturing is going to pick up. But tell us what Jefferies is saying.
Absolutely right. The private capex picking up, or the private capex revival. And also, if you saw in 2022, what was actually a consensus overweight was the industrial space, mainly consisting of companies that had a large presence as far as the capital goods space was concerned. So what is Jefferies saying in this particular backdrop? They're saying that 2022 actually saw significant earnings upgrades as well as robust order flow as far as most of the industrial companies were concerned. So they're saying in 2023, the operating leverage that these companies enjoy should continue to surprise on the positive side. And however, one thing that they are flagging out is that the order flow growth that they saw could potentially slow down. They are saying that the sub-segments that they are more positive on in 2023 are the power T&D space, the railway space, data centers, as well as logistics. However, one potential red flag that they are flagging off is the fact that in budget 2023, there could be some commentary that indicates that capex could slow down, and this they are saying is a big red flag. Which are the stock picks that they like at this point of time? So L&T, Siemens, and Thermax continue to remain the top picks as far as Jefferies is concerned.
All right, Vivek, thanks a lot for getting us that report on industrials. And finally, the next one we're looking at is that Citi expects policy factors to favor city gas distributors as well as gas transporters in 2023. Mangalam, tell us more about this.
Well, Citi expects policy and regulatory factors to favor city gas distributors and gas transporters in 2023, like you pointed out, and it's the macro driver which could be a bigger driver, the macro backdrop, so to say. The key thing to monitor as per Citi for oil marketing companies is revised APM prices and any change in allocation towards that. They believe for GAIL and Petronet, pipeline tariff review will be a big trigger. KG gas auction in Jan will be another one. We'll also watch out for crude price trends because they've been volatile and open 90-day positive catalyst, and they've initiated 2 pair trades as well. As far as oil and gas outlook for the year is concerned, they have an overweight rating on GAIL. They believe there is an underweight rating case for Petronet LNG. BPCL is an overweight, whereas Indian Oil is an underweight as well.
Okay, well, to all of you, thanks a lot for joining in and helping us with what the brokerages are saying with respect to individual sectors. A lot of optimistic views there. Let's slip into a quick break. When we come back, we'll discuss what's buzzing in the commodity space with Manisha Gupta. Do stay tuned in.